So hello everyone. Today's video will be relatively short. We'll be talking about the proper trading process, the proper strategy you should follow. So I'm just gonna dive into it directly and then we'll be starting to apply it, right? So every day when I start my process, my trading session, I'll basically have some kind of ritual. So what will I do during this ritual? I always have my journal open. So I read my journal. I recap what I did the previous day, the previous week. I just have a quick overview of what I do. And I have a PowerPoint. So basically, in this PowerPoint, I have my whole uh, trading process outlined in a really nice way that is easy to read and easy to view. And so when I open that PowerPoint, I just use it as a reminder, and this reminder will allow me to basically stick to my rules, and we'll talk about the rules. Okay? And once that is done, I always have some kind of screenshots of good trades and bad trades that also allow me to see uh, to have an overview on my mistakes and the good behavior that I had. So basically, if I have a good behavior, I'll take a good trade. If I have a bad behavior, I'll take a bad trade. And if I take a bad trade, that means I wasn't consistent with my own rules, and that's bad. And here's the pain. And if I'm consistent with my rules and stick to my plan and my strategy, here's the outcome that's gonna happen, and the outcome will feel pretty amazing, to be honest. And it does feel amazing. So once that is done, then I get into my session. So there are some rules that we'll talk about. So first of all, I go through market recognition phase. You need to write everything to stick to the plan. And if you don't write everything, you will not stick to the plan for the simple reason that it's simple to think about something and never do it. So you need to write it. So when you feel like something's off, you just pull up the plan, you read it, and you basically follow it. Okay? So the objective of the market recognition phase is to recognize the appropriate market in order to be able to take a consistent action, right? So when you open your chart and you read all what we talked about, to read the price action, the levels, you mark them if you want to mark them, or if you want to keep the chart without anything on it, you do that. And that phase will allow you to basically mark all the important levels and read the trend, of course. So there is a pre-analysis, and the objective of this pre-analysis is to analyze the market state and situation. So it's in uh, two phases. So I always start with the fundamentals. I see, okay, so here are the numbers that we had previously, and we will be having some kind of release today at market open or after market open. And once I recognize that, I always correlate it with the chart. Once I read the chart, I read the trend in the chart, and like David Paul used to say, rest in peace, he used to say the fundamentals are basically used to see the overall state of the market. Yeah. And the technical analysis is simply used to see the current trend. And the fundamentals will be allowing you to calculate the fair value of the asset, while the technical analysis will allow you to see the trend and take advantage of the trend. And there's another thing, correlation. Of course, I'll correlate the fundamentals with the technicals to see everything make sense. Once everything makes sense and I have the whole analysis prepared, I am able to trade. I usually trade during market open, so I should have all this set ready, all this analysis done before market open. I usually wake up 1 hour before market open, or I just like sit in front of my charts 1 hour before market open, so I'm ready pre-market. Then I define the trade basically, and the objective is to pick the most appropriate markets, the most appropriate pairs in these markets for the day, and this can be a second filter of the first list of pairs selected from the previous pre-analysis step. So basically, when I'll sit down, right, and I'll do my analysis pre-market. Sometimes you could be wrong and expect some kind of assets to move, and these assets at market open don't move, but others move. So once, for example, if you're a forex trader, once you have, let's say you have your whole list of USD pairs, and you see some pairs in USD moving, you may ask yourself, are these moves related to USD or related to the other currency that is linked to USD in this particular pair, right? And if, for example, you see CAD USD moving, you don't see other USD pairs moving, but you see all the CAD pairs moving, that is correlation. So you would basically have a conclusion that, okay, CAD is being active today. And this is where you want to be. You want to be in an active market. Okay? And you'll have to basically define the type of trades that you want to take. You define it beforehand. You need to define the trade beforehand. So this is what I want to see. If that doesn't happen, that I'm not taking that trade. If you want to draw it, you draw it. If you want to just like read the market, you read the market, but you want to adapt yourself. If you're too fixed into a certain direction, if you're too fixed into selling or buying, you might bias yourself. You don't want to be biased when you trade. You want to adapt to the market. So you just read the market. You define before that market forms, that movement forms. You define the trade that you want to take. Okay. If that setup doesn't draw itself, if that setup doesn't happen, you do not trade. At least you do not trade that asset at that moment. Okay. And if you think that you were wrong and the price will actually go to the opposite direction, then you redo your analysis, and your action must have a certain logical reason, rational reason behind it, so you can take the trade safely and manage your risk, right? And then here are the rules I was talking about previously. So trade during a session, that's super important. You don't trade outside of session because there is no volatility, there is no movement. And if even if there is a movement, you don't really want to be there because this movement won't necessarily have a purpose or someone behind it, right? So you want to trade when the market is active, when the market is volatile, and when the market moves have people behind it. It has purpose, it has a reason, it's logical, right? So trade during a session or at market open. Be loud and clear. And when I say be loud and clear, it's when you have a strategy, you want to be exactly clear in what you're doing. Okay? Everything needs to be clear. No double thinking, no hesitation, no doubt. You want to go for it, you go for 100%. It works, it doesn't work, it doesn't matter because you have delayed feedback and it's all about risk management and probability, right? Okay. Take my time. When I wrote this, what I meant by taking your time is basically you don't want to rush taking the trade. I know I'm an aggressive trader, so when I see something, I want to get it beforehand. I want to get the full move. However, I know how to manage my trade later on. If you're more conservative or you hesitate or it's not an A plus setup and you're sure that it's going to go that way, etc., you want to take a bit more time. So you want to be sure that at the moment you're going to enter, you're going to take that trade and get into the market. You want to be sure that this is a safe zone. Okay, so take your time to analyze. If things feels off, don't get in the market. Okay, except if you're advanced and you know what you're doing. Okay, know quickly if I am partially right, if I took the right action, and if the trade is performing as planned. So basically when you take the trade, I used to trade intraday. Today I trade swing, right? But when you trade intraday or swing or you invest, you need to know how right are you. If you're right, then the price will directly move to your take profit. That's if you're 100% right. If you're partially right, it might go against you or take its time and then go towards your take profit. That's if your stop loss is at the right and proper level. And if you're wrong, it will go to your stop loss and you'll see it go into your stop loss. So when I manage my trade that way, what happens is that if it goes against me, I directly close the trade. I don't want to see a full loss or my SL get it reached. If I'm wrong, I'm wrong because I got into a safe zone. The price should directly go towards my take profit. If it doesn't go towards my take profit and go toward my SL, that means I am wrong because I got into a safe zone. It's supposed to go there from my analysis. If it doesn't go there, I close my trade. I was not supposed to be there. I'm wrong. It's okay. I will get into the market later on. Now, if I close my trade and then I see another opportunity or the movement is like reversing to my level and I see the price going towards my TP or about to go towards my TP, then I get back into the market and I ride the full move. Okay? Have a decent move and duration on trade. So, what I mean by that is that if you are trading swing, for example, you should have some kind of expectation of how long the trade is gonna take. If the trade takes, for example, more than 3 days, you might ask yourself if you should close the trade or not and get out of the market. When I used to trade intraday, if for 1 hour the price ain't going anywhere, I'm closing the trade. I'm closing the trade. Because it might take me, for example, from market open 30 minutes to get a good setup. Then I get into the trade and then I'm 1 hour into it. So meaning 1 hour and a half into the market opening, and I should be closing my trade 2 hours after market opens or 3 hours market after market opens maximum. Okay, so if the trade is not performing, I'm just closing it. It's taking too long to perform. I don't want that because that can go against me. And I want to reduce the odds of the downside, right? Know the reason and the situation. You should always know the reason within the context that you're trading. And I talked about this multiple times, so I won't dive into it. Be able to explain each step. So, being able to explain each step, it means that if I just get into your trading room and I look at you and I'm like, why did you do this? You should be able to explain me exactly why. And if you're not able to explain me exactly why you did this and you took this trade, then it's probably not a trade you should have been taken. Okay? Be psychologically flexible and adapt. So that's what I was talking about when I was saying, hey, if the trade is not performing, if it's not consistent with your rules, if you're not consistent with your own rules and you don't respect your own strategy, hey, you should be psychologically flexible to close the trade, to change direction if you're wrong, to readapt to the market and the price flow, the price of the movement of the price, right? Be consistent and clear. That's what I was talking about. Stick to the process again and be available now, objective and focused. What I mean being objective and focused and being available now, that means you don't want to be distracted by anything else. You're here with your charts. Nothing exists on earth. It's only you and your charts, only you and the market. That's it, right? And then, of course, define your blueprint and edge. So act consistently and follow the process. Again, it's always good to have reminders. Now, your blueprint. So what's your blueprint? Once you defined all levels, so technically, and you defined, you basically completed your fundamental analysis. Okay? Once that is done, you need to have an edge. You need to see something that you'll want to see. So, of course, you'll be trading while you have either a breach of market, breach of level, or trend. Okay? Then what you'll want to see is a pullback. And after the pullback, you'll want to see the price going back to the direction of the trend or the breach with reason and power. Okay? And then you write it. Okay? I keep it simple because we'll be diving even more and more into it and we'll be using indicators. So for now, you just need this. However, the more precise you can be and add images and add illustrations and add explanations, the better. Then the next step is going to be market trading phase. Okay. So the objective of this phase is to take a consistent action in an appropriate market. Once you have selected everything you need and you see the setup in multiple assets you selected from your analysis, then you want to take action. Okay, so always your take profit should be at levels. So for example, if I see a consensus, if I'm buying and I see that the price is going upwards and at a certain price level above the current price of the market, there is a consensus price, there is a range, there is a point of control. This is where I want to put my take profit, or at least my first take profit if it's the first consensus price or point of control, for the simple reason that the price might react from these levels, okay? And it might go back against you, or it might not continue to go up. So you want to be safe there. And this should have a reason, and the reason is simply that, hey, there are orders there that might push your price against you. So you want to put at least your first take profit there to be safe and secure some profits. Then, if the price continues going up, you scale up. Boom, boom, boom. Okay. Your stop loss should be below levels, not above levels. If the price is going up and there's a consensus price or a point of control below the level you traded or a range, you don't want to put your stop loss at that point of control, at that price. You want to put below it, okay? You want to put your stop loss where you think the price will never ever be able to reach. Don't put it, you know, down to like zero. Just put it at a good level, okay? So I so you put it below the money spot, and when I talk about the money spot or DOE or traps, all these are keywords that are invented as labels. I don't really like them. So I'm just gonna rewrite it, okay? I'm just gonna do it like this. Below points of control. Okay? Then the entry price need to be a good deal. So again, I'm going to say it again, and I'm going to quote David Paul once more. A good trader would rather die than chase the price. Because the price, you're basically dealing with the market, and you need to have a good deal. You need to buy an asset at a good price, and you need to sell an asset at a good price. And the price must be low when you buy, relatively low to the context, and high when you sell, relatively high to the current context. Okay? And the exit price, of course, is going to be either at a profit, but I'm going to give you a simple answer for the exit price. When you see the price going against you, you close the trade. That's your exit price. When you see the price going with you, you scale up, you enter more, you don't exit. Okay? Most people will see the price going with them at a profit and they'll close the trade to secure profits. That's bad. That's a bad behavior. You scale up, you enter more trades, you take more trades. And if the price goes against them, usually people, what they do to avoid pain, they hope. They get more and more optimistic that the price will go with them. Wrong behavior. You close that trade, you close it. Okay? And then I talked about scaling in, scaling out, and scaling up. And then, of course, you want a good risk management. So the risk must be fully accepted. When you take a trade, you need to fully accept the risk. Why? Because if you don't fully accept the risk of losing that amount that you risked, you'll be biased, you'll act irrationally. You don't want to do that. Take only one trade at a time. That's for, of course, when you're beginning. You don't. The problem with taking multiple trades is you have two problems, two issues that you need to be able to deal with. You have a problem of management because you need to manage all these trades that you're taking, and if it's only one, you can manage it easily. And the risk you're taking is going to be, if you take two trades, it's going to be doubled. If you take three trades, it's going to be tripled. Or if you are able to manage the trade, but you want to take the same risk than one trade, you just don't put your same eggs in the same basket. You just break the risk through all the trades that you're taking. Okay? Then you need to risk low. Well, I put 0.5%, but the maximum is 1%. Okay? And I want, based on my strategy, a minimum risk to reward of 2.3. Why? Some kind of strategy have a win rate of, for example, 40% or 45% like me. So I need a risk to reward that is above 1 to 1, at least 2 to 1. So when I lose, for example, 51% of my trades, I still make money. Or 55% of my trades, or 60% of my trades, I still make money. However, if you have, for example, a 50-50 win rate, a 50% win rate, or 60% win rate, then you allow yourself to have a 1 to 1, because if you lose 40%, you make 60%, you're still profitable. It's all about maths, and it's very simple. So right now you had a full overview of my own trading process, and I tried to explain it as concisely but as detailed as possible at the same time, and I try to be clear. I hope that helped. And now we'll be diving back into the chart and applying this strategy. I'll see you there, and I wish you all the luck.